What do you say we go through a couple of different ways for you to build yourself a $1 million investment portfolio? Sound good to you? Okay, let's go. Sometimes I lie around and think about random things, like why does the door close button on an elevator even exist when it never works? At what age should I actually grow up? And of course, why does my dog have a tail? Because it serves no other purpose than smacking little kids directly in the face. I asked myself this same random question with investing money and came up with this one. I'm going to go through some different combinations that could lead you to a more than $1 million investment portfolio. Now, I give enough examples to where every single one of you can at least find one that will fit your lifestyle. I'll have to admit that I like one of these more than the rest. I'll let you know which one it is once I get to it. Hey, I'm Jarrad with an A, and on this channel we talk about all things personal finance, investing, and we try to have some fun in the process. Sometimes we all get stuck in the details that we start to lose sight of the overall plan. The point of this video is to get you to zoom out a little bit, to think about the bigger picture and the different investment combinations that you can use to build your overall wealth. Think of it like a choose your own adventure book, but this is a real life game that is way more fun to play with real money. I chose $1 million because it's just a nice round number to work with. All of these numbers are based on a single person because they're easier to calculate in general. So if you're one of the many lovebirds out there, then just multiply these numbers by however much you like. We're gonna call this the 2 comma trifecta test. Get it? $1 million has 2 commas in it? No? That was really dumb. I'm sorry. We always see news articles pop up about how much you should have saved by each age. Now, this gets a ton of people discouraged for many different reasons. If you've seen these articles, I'd like to ask that you don't let these kinds of things make you feel bad about your situation. Yes, they're a good guideline, but this is all based on a perfect scenario, and life is just not that cut and dry. Some people are a little behind because of student loan debt. Some people are behind because they weren't taught about money and investing a lot sooner. Some are ahead because they've been using the bank of mom and dad to get themselves ahead. And some have just had a little luck on their side with investing in the right things at the right time. I want to encourage you to ignore these stats you hear. You need to stay in your lane and focus on where you should be based on the past events that led you to this point. What you do between now and when you retire will have the greatest impact on your future results. There's always going to be people ahead of you and even people behind you as well. Quick disclaimer, I'm not a financial advisor. I'm not giving you any investment advice. This video is for information and entertainment purposes only. Do your own research or talk to a professional instead of listening to me. The options we're going to be using for the following examples will consist of a 401k, Roth IRA or traditional IRA, HSA, and real estate. There are many other vehicles that you can use outside of these four, like building a business, but everyone watching this should have access to at least 2, if not all of these. If you don't have access to a 401k, then just substitute a 403b or 457 if you have access to one of those. Let's touch on the inputs that go into these 4 investment options that we'll be using. With anything tied to the stock market, I am going to assume a 7% return. With a Roth IRA, you can contribute up to $6,000 per year right now, which comes out to $500 per month. With a 401k, you can contribute up to $19,500 per year, which is $1,625 per month. And with an HSA, you can contribute $3,550 per year at this point in time, which is about $296 per month. Real estate is going to be the wild card here because there's technically no limit on that one, so I'll make up some realistic numbers. Here's the ground rules. Each property purchased, you're going to buy a $100,000 property. You're going to get a 30-year fixed mortgage. You're going to put $10,000 down and spend $3,000 on initial upgrades, which comes out to $13,000 cash out of pocket. Now, we'll assume that after all expenses are paid, you'll cash flow $150 every single month per property. Towards the end of the video, I'll throw up a screenshot of all of the numbers I use to calculate everything so you can get a nice little overview of everything all together. As I go through each one, let me know down in the comments which one really speaks to you at a deep level. I'd be curious to hear your thoughts. Let's get into it right meow. The first investment combination I'll call the the don't make me think too hard portfolio. This is only taking into account one thing, and that's the 401k. It's about as simple and straightforward as it gets. If you decided that you wanted to only max out your 401k, then you'd hit the $1 million mark in 25 years. At that point, you'd have a little over $1.2 million, and at a 4% withdrawal rate, you could pull out about $49,000 per year. Bonus points if you max it out for an additional 5 years, because that $1.2 million would turn into over $1.8 million, and you could withdraw $73,000 per year as opposed to $49,000 per year. Keep in mind that the downside of this one is that you're only investing through your employer's 401k, and that is it. I'm not the biggest fan of this one, but it is an option for you. Next up, we have the, okay, I'm willing to think just a little bit harder, but let's not get too out of hand investment portfolio. This one is going to take into account a 401k and Roth IRA. The plan would be to max out your 401k for 20 years, which would turn into about $800,000. You'd then max out your Roth IRA for 20 years, which would turn into about $246,000 and give you a total of $1,046,000. If you didn't add another dime to any of those accounts, then in 10 more years, that $1,046,000 would actually grow to over $2,057,000. Yes, it would double by you not doing anything else. Before we go any further, I've been asked by my dog Molly to have you Hulk smash that thumbs up button. Please. The next combination I'll call the working man or woman's investment portfolio. This is also going to be heavily tied to the stock market. For this one, we're going to be investing in an HSA, 401k, and Roth IRA. Maxing out an HSA for 30 years, a Roth IRA for 30 years, and a 401k for only 10 years, then moving all of your 401k money into bonds, you'd have over $1.1 million. If we are getting technical, then your 401k would most likely sit there invested for 20 more years without you contributing any more money, but it would still grow. And because of that, your $1.1 million portfolio would be about $1.9 million. Keep in mind that after you max out that 401k for 10 years, you're going to have a boatload of extra cash sitting around. At this point, you'd have $19,500 per year that you're not investing technically based on this scenario. Now, you were smart up until this point, so I'd assume that you continue investing that money somewhere, which would net you way more than $1.9 million after that 30-year mark. Combination number 4, we'll call the I'm a company man or woman from 9 to 5, but I also want to do some moonlighting on the side investment portfolio. With this one, we start adding some real estate investing into the mix. You'll be utilizing a 401k and 2 rental properties. This would be the perfect situation for someone working a corporate job that wants to give their net worth just a little bit of a boost. I take that back, a major boost. For 20 years, you max out your 401k. That would grow to be worth a little under $800,000. Once again, technically, if you just stopped investing into that 401k and let the $800,000 sit there, then it would grow to over $1.5 million in another 10 years, but that would kind of mess up this whole thing. So let's assume you need to make up an additional $200,000 somewhere. And in this case, it would be with rental properties. You then purchase 2 rental properties, the first one this year and the second one next year. They each cost $100,000, and your initial investment into each is going to be $13,000. Like we said at the very beginning, $10,000 for a down payment and $3,000 for upgrades. That's another $200,000 in paid off houses to add to your net worth in 30 years, plus you'll be putting even more money into your pockets from the rent because less will have to go towards the mortgage at that 30-year mark. Oh, and did I mention that during those 30 years, you were cash flowing $150 per month per property? So during that time, you'd make an additional $108,000. But of course, you'd be increasing rent during that time, so technically it would be way more than that. But I mean, Who's counting, right? Now to the one that we've all been waiting for. Well, at least I've been waiting for. Combination number 5 is called the I think I just pooped my pants, because this is amazing investment portfolio, aka the Hammer of Thor investment portfolio. It gets really fun because we're going to add in even more real estate. Now, this is definitely my favorite combination of all of them. For this example, you're only investing in a Roth IRA and buy and hold real estate. Here's what you do. You're going to max out your Roth IRA for 30 years. Now, this portion of your portfolio would be worth about $566,000 by that point in time. On the real estate side, you're going to purchase one $100,000 property every single year for 5 years in a row, put $10,000 down, and spend $3,000 on initial upgrades. That means you'll pay $13,000 cash out of pocket per house. Now, if you can't afford to put $1,100 aside per month to purchase next year's property, then you need to find a way to make more money. Now, around here, we don't accept the words I can't. We just don't. We accept the words I'll try. At the end of those 30 years, you'd have 5 properties that are completely paid off and worth at least $100,000 each, or $500,000 total. They'd most likely be worth more than that, but let's assume that nothing increases in value just to make it simple. Between your Roth IRA and real estate investments, you'd have a portfolio worth about $1,066,000. On top of that, you were cash flowing $150 per month per property, which means that you would have been pocketing $54,000 per property over those 30 years. So technically, we can add that $54,000 times 5, which comes out to $270,000, to that $1,066,000 that you already have. This cash flow would most likely be higher because you will increase rent many times over that 30-year period. To top it off even more, now that those investment properties are paid off, you can pocket the full rent payments minus the amount you set aside for expenses every month. So let's assume that you'll pocket, we'll say $650 per month per property. That's $7,800 per year per property, which is, wait for it, $39,000 per year. Once again, not to mention that you're absolutely going to be increasing rent over that time. So this estimate is very modest. Yes, this is real life. Here's a quick snapshot of the numbers that I used. If you want to take a look, then press pause on the video to take a look for yourself. For the HSA, 401k, and Roth IRA, I just used a simple compound interest formula to come up with those numbers. In the description of this video, you can go pick up your free investing platform guide. You'll also find a ton of resources to help you out with all of your personal finance and investing needs. Make sure to check out these videos to your left on how to build a $300,000 tax-free HSA account, as well as the video where I show you how I invest in my Roth IRA. Make sure to Hulk smash that thumbs up button. I'll see you in the next one, friends. Adios.